Welcome, everybody, and thank you for joining us for this event sponsored by the Connecticut Technology Council. I am Giovanni Tomasi, Chair of the Council, and I have the pleasure to introduce Bill Claffey from Fiondella, Milion, and La Sarcina. Bill will tell us about new tax laws related to research and development expenditures. Bill heads FML state and local incentive tax practice with a primary focus on income tax, sales tax, and federal and state credits and incentives. Bill's experience includes analyzing the many state tax issues related to the operation of businesses, identifying credit and incentive opportunities, and representing clients in state income tax related matters. Bill has worked with a diverse array of biotech, medtech, and advanced manufacturing clients, including Oxford Performance Materials, the Eastern Company, and Torigen Pharmaceuticals. Bill also provides extensive sales and use tax consulting, including representing clients in sales tax related matters. Prior to joining FML, Bill had over 9 years of experience in the Stanford and Hartford offices of Ernst & Young. So after Bill's presentation, we'll have 15 minutes for questions. So please use the question tab at the bottom of the screen to get into the queue. I now hand it over to Bill to start the presentation. Thank you, Bill, for joining us, and we're looking forward to what you can tell us.
Okay, great. Thank you so much, Gio, and welcome everybody on this lovely Wednesday afternoon. If you haven't heard about this topic, I'm glad you're here. If you've heard of it and want to learn more, also glad that you're here. It's certainly been a very hot topic, really since 2017, but it wasn't put into play until 2022. And there's been a lot of support from Congress to get this, at least with regard to the first topic we're going to discuss with regard to Section 174, get these provisions repealed. So let me just give you a brief history. Certainly anyone in the tech sector and really a lot of other sectors, software development, biotech, manufacturing, so forth. They all have research expenses that are related to their business. And since 1954, Congress has allowed, and the IRS has allowed, taxpayers to immediately deduct those expenses against any income when calculating their federal income tax, whether that be at the corporate level, whether that be in a pass-through entity type structure, S Corp, and so forth. So that's always been policy. There's always been tremendous support from Congress to incentivize research and development. In 1981, the Congress passed the first version of the research and development tax credit, and for companies that are investing in research and development here in the United States, that provides a significant offset to taxes if they have taxable income and tax in the current year, and it can certainly provide credit carry forwards to offset future taxes. Our next kind of key date, and just with regard to the R&D credit, it was one of those credits that had been enacted but sunset after 2 years. Then it would be enacted, and then it would sunset after 2 years, and then sometimes it would be enacted retroactively, but applicable back to the open period. And so since 1981, there's only been one disruption to the R&D tax credit, and that was in 1995, and it was only for 6 months. Other than that, the credit has been around and folks have been taking advantage of it. So let's fast forward again to 2017, and you've got the President Trump, the TCJA, Tax Cut and Jobs Act. And there was a lot of provisions in there that were very taxpayer friendly, but as with every act of Congress, there needs to be some sort of a budget balancer. And the budget balancer, one of them was this concept of amortizing research expenses instead of allowing for a current deduction. That was set to take place for tax years beginning January 1st, 2022 and forward. Now, since that date, 2017, since the enactment of the TCJA, there has been constant discussion about how, one, it's bad tax policy, and two, it's going to be repealed. At a minimum, it's going to get deferred for 2 to 3 years. And so we sat there and we waited. 2018, 2019, 2020, 2020, all the way to 2021. As we got into 2022, I mean, we're in the middle of the tax year, but obviously we're not filing those returns until the current year we're in right now. But there had been no official repeal of that provision. There had been tremendous bipartisan support. The Senate Finance Committee voted 95-5 to repeal the provision, but it just couldn't get traction when it came to the infrastructure bill, the Build Back Better bill, and any other legislation that came about, the appropriations bill that we thought it would come through in December of 2022, and it just didn't. So that's where we are today from a historical perspective. And now I'd like to kind of dig into some of the details. And we're going to talk about two things. We're going to talk about this whole 174 impact. And then we're going to go through, and if you've been involved in a biotech company in the past, you probably have taken advantage of the credit, but we'll go through those rules. There's been a slight change to the credit, which is beneficial to taxpayers, and we'll review that. But if you're not familiar with the credit, hopefully you can learn some information here regarding the credit, how you can take advantage of it, how you can possibly monetize it, whether it be a federal or state credit. Okay, so I think the first thing is just to understand, and it's pretty simple, but what the old law was and versus what the new law is. So again, since 1954 through 2021, any expenditures that were related to research and development expense were allowed as a deduction. They were categorized under Section 174 of the Internal Revenue Code, and the taxpayer had the option to either deduct them in the current year or amortize them over 5 years. Now, most of my clients, they elected to deduct them in the current year. They wanted that current year deduction. If that resulted in a loss, it created a loss that could be carried forward for 20 years. But we did have some clients that did elect to defer those expenses and amortize them over the 5-year period. Again, that was an option. It was an election of the taxpayer. When we get to years beginning in 1/1/22 and forward, so anyone that's on a calendar year basis, if you have a fiscal period, let's say you have a June 30 year end, it would apply to your year beginning July 1st of 2022 to June 30th of 2023. So we're really looking at the start date, but the new law says that expenses for research and experimental expenses in connection with your business are not allowed as a deduction, but rather they're charged to your capital account, and they're amortized either over a 5-year period if they're US-based expenses, or in the case of foreign research, they're actually amortized over a 15-year period. So we're going to go into some examples, but you can see this is going to have a very drastic impact on many companies, whether they be in biotech or any kind of tech sector, whether they be startup companies, whether they be more mature businesses. There's going to be an impact. Okay, so 174, how is it defined? For folks that are more comfortable or have gone through like a research and development tax credit study or a review, some of the definitions are similar. There are some differences, which we'll talk about. But the definition of research and experimental expenditures is exactly what you see here on the screen, right? So it's expenses in connection with your trade or business that are research and development costs in an experimental or laboratory sense, right? So anything related to trying to discover information related to a new or improved product, and product can mean multiple things, and we'll cover that in the third bullet. Anywhere where you have uncertainty. So uncertainty regarding whether you could develop the product, how you could develop the product, or even the appropriate design. And those tests are all very similar to what's incorporated in the R&D tax credit statute, which is Section 41, which we'll address, but they're also incorporated in 174. And the tie-in was Section 41 would bring you to 174. But in the past, we never really had to worry about those costs because they were always deductible. And then the third bullet, product, right? So what is a product? It's any product, process, formula, invention, technique, patent, or any kind of other similar example. The key thing here to kind of focus on is it could be process related, right? You could be You could have a product that you've designed, but you're trying to design or develop a manufacturing process. Well, that process could also be considered to be research or experimental expenditures, to the extent that there's technical uncertainty and you're trying to discover information. So some of those tests are very similar to what we've seen with the R&D tax credit in the past. Okay. What about the cost, right? So that's the definition. The definition's pretty loose. There's not a tremendous amount of guidance there within section 174 on the definition. But when we look at certain costs, we're looking at, these are specific costs that are there, but we're going to get into some of the actual, like, more mechanical accounting costs, right? But any patent costs, right? So if you're inventing some sort of a product or a prototype, and you're expending money on attorney's fees for patent costs, those are also included as 174. Another point that's made is, regardless of success or failure, any cost where you're trying to discover information whereby there's technical uncertainty, those are eligible costs regardless of the success or failure. Version 2.0, that's kind of an example of certain costs that you could incur, possibly in my manufacturing example, incurred after production begins, but there's additional uncertainty in either a second version of the product or the software, or there's uncertainty with regard to the development of the process. And then amounts paid to others. So any amounts that you pay to a third party to provide research and experimental expenses or activities on your behalf, those are also considered to be amortizable section 174 costs. This last bullet, treatment upon disposition, retirement, or abandonment, there's no deduction if you terminate a project, or you terminate a product, or you abandon a process. You continue that amortization. Arguably, if you were ever to exit the business, you'd have additional basis, and so you would get relief from a tax perspective upon exit. Okay, costs. We've got a delineation here between 174 and section 41. And again, if you're familiar with 41, you know that 41 is W-2 wages, supplies, 65% of contractor costs, and that's it. And we'll kind of get into that. But for the 174 costs, it's really any costs that are incurred related to research and experimental expenditures. So clearly, wages paid to employees that are performing research activities, those are eligible for the credit. They would be categorized as 174. I say eligible, but really categorized as 174. 174 is a bad answer, right? Credit's a good answer. 174 is kind of a bad answer, but those would be costs that are 174 costs. Any kind of supplies, any amounts that you pay to third parties. And so if you're familiar with the R&D tax credit, to the extent that you are paying you're paying another third party to provide research expenses on your behalf, there's this concept of who has the risk and who has the potential for reward, who owns the technology. And if you're a business that's receiving funds from a third party, you've gone through an R&D tax credit analysis, there's this concept of funded research, right? Where if you're being paid, if that research is funded by a third party, then it's not a credit eligible cost. At the current time, if you are the party being funded to provide research, that's still a 174. It's a 174 cost really for both parties. And there's been a lot of uncertainty regarding it. It doesn't seem to make a lot of inherent sense. But there's nothing in the 174 guidelines, regulations in the statute that say that you would separate that cost and assign it to one party or the other. And then the last bullet here, which is pretty important, is that your 174, they don't define kind of the but for and only costs that qualify. It's just all costs incurred. And so the prevailing position on this is that there is going to be some piece of overhead that you're going to have to allocate to your 174 research costs. So for example, if you had 10 employees and they were all making $100,000 a year and they were 75% performing research and experimental activities, right? You'd have $750,000 of wages that would be deemed to be 174 costs. But what about the benefits? What about the payroll taxes? Under a 174 analysis, you'd have to come up with some sort of an allocation of those costs as well, because those are costs that are incurred ultimately for research, even though they may be indirect in some manner. Also, rent and depreciation expense, and this is something that's kind of a very new concept with regard to 174. But if you buy assets that you are going to be using for research purposes, you don't deduct the cost of the asset, much like you never would have in the past. You may have gotten bonus depreciation on that asset. You may have taken, simple makers depreciation on that asset. Under the current rules, that asset becomes a depreciable piece of property. Let's say it's a piece of M&E. But every year that you're getting a depreciation expense, you need to recategorize that depreciation expense and then amortize that over 5 years. It's tricky. Believe me, we're still working through some of the kinks of how do we make that work within our tax software. But until additional guidance is provided, that's the way the code is written. And that's the way that our firm and every other firm that I've connected with, that's the way we're handling it. So you got to think about which assets you may have acquired that would be research assets. If the asset is used only, a very small portion is used for research development, you got to draw a line somewhere. But for those assets that you're using primarily for research, I would look at amortizing the depreciation expense. Okay, so what about grants? This question came up, and it's come up frequently. I haven't seen the Internal Revenue Service specifically address this, but we have clients and that are 100% grant funded, or highly grant funded, right? They may have $1 million of grant funds that are used to fund wages, maybe purchase of equipment, certain other items, maybe supplies, maybe pay for rent, however the grant is written. And some of those grants may be coming from the federal government. Some of them may be coming from other private agencies. Some of it may just be, funded research from a third party, a joint venture, something of that nature. Well, under the current law, that grant income is income to the taxpayer, right? So in that simple example of I have $1 million of grant income, and then I'm using that to, and the grant requires that I spend it on research expenses. I've now gotten myself in a situation where I've got $1 million of grant income, and I have $1 million of research expenses that were funded by that grant income, and I can only amortize those expenses over 5 years. And we're going to get into how that works. I've got a couple nice examples that I think we can walk through and you can see. It's been deemed to be an unintended consequence, but until there is a change in the law, that is the way that that's the application of the way the statute is currently drafted. Okay, so kind of talked a little bit about the difference between Section 41. I know I've got some slides that are going to go through a lot more detail on Section 41. But understand this: if you've done an R&D tax credit study, you've got a Section 41 pool of costs, which is wages, supplies, 65% of consulting fees, and then you get your 174 costs. And I don't know if this diagram is exactly appropriate, but understand that your 174 is likely going to be bigger than your Section 41 costs. some special rules. I'm not going to get into these into too much, other than just to note that there was a specific note on software development that all software development costs are now considered to be 174. 174 research costs and need to be amortized over 5 years. Exclusion. So this is again very some of the similar language to 41, and there is a connection between the two. But anything in these bullets here is generally not considered to be a 174 cost, right? So if you are doing, you're doing efficiency studies on, or you're researching market costs for a new product, right? That's not a 174 cost. Control testing, that's not a 174 cost. Okay, so let's get into the examples. I think seeing an example is probably the best way to is the best way to visualize this. So this is kind of the pre-22 rule. So 1954 to 1921, your general expensing of R&D expenses. So in 2022, again, if we were using the pre-22 rules, you would have had, if you had $1 million of R&D expenses, and let's say of that, you had $800,000 of R&D tax credit eligible costs, you would expense that $1 million every year, right? So you can see that we're expensing $1 million in 2022. Again, please remember this is before the amortization rules, right? If those rules had not come into place, that's what this is. Well, the next slide will get into the amortization impact. You're expensing your R&E expenses each year, bringing your taxable income. Let's say we have a taxable income of $1 million. You're bringing your taxable income down to zero, assuming a corporate tax rate, no tax. And then we're generating an R&D tax credit. And again, it's using very static numbers, but you're generating a tax credit of $56,000 a year using the simplified method. And what does that mean? Well, that credit's not going to be used to offset any tax because you don't have any tax. But if you were a qualified small business, you could have been using that credit to offset your payroll taxes, and we'll touch upon that. Okay, so that's the pre-rules, right? So again, remember that this slide is if the new 174 laws had not put into place. Okay, now we get into the the current rules, right? Same fact pattern with regard to R&D expenses, R&D credit costs, right? But we are required, let's look at 2022. We're required to amortize that over 5 years. And the reason I don't have a 5 years here, I've got 6 years, is that they also added what they call a mid-year convention, meaning that you can only take half of that 20% amortization in year one, and then you take the other 10% in year 6. And in the middle, you're taking your normal amortization. So in 2022, we've got $1 million of income. We've got $1 million of R&E expenses. In year one, because of the mid-year convention, we can only take a $100,000 deduction. Well, that means I've got $900,000 taxable income. I'm paying tax of $189,000, assuming the corporate rate of 21%. I can generate a credit. My credit costs aren't limited only to my amortizable costs. So I'm still looking at my $800,000 of R&D credit costs. And so my tax bill goes down by that $56,000 of credit. But if I'm a qualified small business, I don't get to use that credit against my payroll tax, and touch upon that real quick. But as you can see, this is going, and so as you look at the schedule going across, you can see in year one, 2022 is the real year you take the biggest hit, because I'm only getting really 10% deduction for that $1 million. When I get into 2023, I'm in year 2 of my amortization of my 2022 expenses, and I'm in year 1 of my amortization using the half-year convention of my 2023 expenses. So I get a $300,000 deduction, and kind of so forth and so on. And ultimately, by the time you get to 2027, you're kind of back where you belong, but you've paid all this additional income tax in the prior 5 years. This is obviously, like I said earlier, very bad tax policy, extremely bad tax policy, especially given the history of U.S. tax policy, which was to invest in research. This is going to de-incentivize investment in research. So hopefully that example is clear in its application. I know it's a lot to take in, but you can see what the tax do. You can see my tax bill going down as I go through the years because I'm catching up on my amortization. They have not said what happens if, let's say, in 2026, Congress comes in and says we're going to go back to the 100% expensing concept. Are they going to allow a full deduction at that point for anything that was amortized in the middle of their amortization period? We don't know. They haven't said so. Okay. So that's basically the 174. That's the impact. That's kind of the nuts and bolts of what it is and how it could potentially impact your business. Under like this fact pattern that I've set forth for everyone, this is the kind of the worst fact pattern, right? I mean, this is that company that's got $1 million of income and has $1 million of expense. Your grant funded companies, they're going to get stung by this. And, and until there has been a history, like I said, with the credit and some other provisions where Congress has acted after the fact and applied it retroactively. That's what it would take. And at this point on March 22nd, I don't know if we're going to get there. It would require amended returns. A lot of partnership returns have already been filed. C Corp returns are due in 2.5 weeks, 3 weeks. Okay, section 41. I'm going to go through this relatively quickly because we've already touched upon some of the concepts. But the upside for research expense is that you still have the credit. And actually, there's a provision in that 2017 TCJA that modified section 280C, which generally required companies to take what they call a reduced credit. So since 1981, when the credit was introduced, if you received $100,000 credit, you either had to add the credit back to your income, right? So you're getting taxed on that, or you take a reduced credit. And the reduced credit is the credit times the corporate tax rate in effect at the time. So in 2021, prior to the enactment of this legislation, or not the enactment, the commencement of these new laws, if you had taken an R&D credit with the corporate tax rate being 21%, if you took $100,000 credit, or if you earned $100,000 credit, you likely took the reduced credit and claimed $79,000 on your tax return. Under the new 280C provision, they've changed the mechanics of of that language, and there's very few situations where you'd ever be required to do it to actually do that add back. So what we think is going to happen is that companies are going to be paying more tax, but the credit's going to go up by that 21% that you would have normally taken on the reduced credit. So we kind of covered that. One thing here on the last bullet is that there's this small business credit. So if companies, in order to give a little bit more teeth to the R&D tax credit, there were many companies, including a lot of startups and tech companies, that were unable to use the credit because they weren't generating taxable income to use the credit to offset that tax. And so in 2016 and forward, companies if they were in that situation and they were considered to be qualified small businesses, they could elect to take the R&D credit and use it to offset their payroll taxes. I'll talk a little bit about that toward the end, but that was that amount was capped at 250 and at 250,000, and it got raised to 500,000. But that was always a nice little area where companies that weren't generating taxable income could actually use the R&D credit to their advantage. Qualified research expenses, we kind of touched on this. I'm trying to be mindful of time here. Wages, generally W-2 wages. If you have self-employment income, that can also be included. Materials, and 65% of contract research. Again, that 65%, that's an R&D tax credit amount. If we're talking about a 174, that's 100%. There's multiple ways to calculate the credit. The 14% is the alternative simplified that was introduced by the IRS, I believe in late 2000s. And it basically, you calculate your current research expenses, you compare it against your 3-year average from the prior 3 years. You take half of that and you get a credit of 14% on that delta. Standard method, I'm not going to go into this, it'll be on the slide, but there's a different calculation of the base amount. Sometimes you can get a better answer using the standard method. So it's always good to talk to your tax provider and say, hey, let's make sure we're maximizing our credit based on either method. There's our simplified method, 280C. So this is what I was talking about before. So in the old 280C law, right, it said no deduction shall be allowed for that portion of the qualified research expenses. Otherwise as a credit under section 41. So if you got the credit, you couldn't get a deduction unless you took this reduced credit. And after, the only situation that you really get into an add back situation or a reduced credit situation is when the credit exceeds the amount of the deduction. We have seen a couple fact patterns where there's a small delta there only for year one, but every other year, that's not going to be the case. So here's qualification of cost. So we look at, again, now we're in section 41 of the code, the research credit. And you can see right in the first bullet, got to be 174 cost. That's our technical uncertainty test. Undertaken for discovering technical information. It's got to be a new product or process. So again, some of the similar language. The last bullet, in order to be a tax credit eligible cost, there has to be a process of experimentation. Now, normally those go hand in hand, and it's doubtful that you have 174 costs without a process of experimentation, but it's not required to be 174, and it is a required element of section 41. Again, we have a list of some of the excluded categories, and some of this is kind of copycat from 174, but this funding is not. This is very different for the R&D tax credit. Anything that's funded by a third party, where the taxpayer doesn't have the rights to the intellectual property and they're not at risk. For example, you may have a time and materials contract where you're being funded by a third party and they ultimately own the IP. That's not a research credit eligible cost. If you have a fixed fee contract where you're at risk and there is an ownership of the IP by the company performing the research, now you're at risk and you have ownership. So therefore it's not deemed to be funded. So could get a different answer for section 41, section 174. Both of them are going to be considered 174 costs. Activities occurring outside of the United States. So everything with regard to our research and development tax credit has to occur in the US. More excluded activities. Anyone that's in the software industry, just understand that there are additional requirements and almost unattainable requirements if the software is considered to be internal use. And so that's typically that's been defined through case law to be software that's operating back office functions. If you are developing software for use in your business as either a process or a saleable software, then that's not internal use software. And so these additional standards don't necessarily apply. Okay, last slide. We touched upon it. Monetizing R&D tax credits. So we are lucky here in the state of Connecticut that if you are a C Corp, you are deemed to be a qualified small business, which is under $70 million of gross receipts in the current year. And you operate at a net loss position, meaning you have to have 0 or less taxable income. Then if you generate a Connecticut R&D tax credit, which is based on a lot of the same definitions, but only for Connecticut expenses, right? So if you have expenses if you have $1 million of expenses and you have $200,000 in Connecticut, say using Connecticut employees, using supplies in Connecticut, and you have $800,000 that's based on your Ohio employees, then you're only going to get credit on the $200,000 of Connecticut expenses. Same with respect to using third parties. If you're using a third party firm that's based in New Jersey, even though they may be benefiting your business here located and domiciled in Connecticut, you're not going to be able to take a Connecticut R&D credit on the services that New Jersey firm provides unless they drive to Connecticut and provide the services to you. It's very geographically bound. But to the extent that you do generate a Connecticut R&D credit and you meet these other definitions, and you're in a loss, then you have the option on the tax return to say, I either want to take the credit and carry it forward to a future year, or I want to cash out at 65 cents on the dollar. And so we do a lot of work with a lot of companies that are doing research and development here in Connecticut. And it's a very valuable tax credit to them because it helps them fund future research expenses. It may result in their ability to hire a new employee. It may result in the ability for them to hire, multiple employees or buy certain supplies. So we've found that to be very beneficial. One of the, to be honest with you, one of the best tax policies that Connecticut has going for it is the ability to exchange your R&D tax credit if you're in a loss position. If you're in an income position, you don't have that option, and you probably don't want to use that option because you'd rather take the dollar for dollar value and offset your Connecticut income taxes. The federal R&D credit, we touched upon this before, but if you're a qualified small business, post 16 and after, you can elect to take your federal R&D credit and use it to offset the employer piece of your payroll taxes. And so you may have a little bit of a bleed on that, where let's say you generate $100,000 tax credit. It may take you, 941, your first 941, you may be able to offset, $15,000 of payroll taxes. Okay. So you carry forward $85,000, then you can offset it $20,000 of your payroll taxes and so forth. But it sure is, it definitely beats having to sit on that credit as a carry forward asset that you might not use if you're in the biotech space, you might not have any ability to use a corporate R&D tax credit for 10 years as you're waiting to generate revenue, as you're going through your, all your testing and all your documentation. So what is a qualified small business? You have to have less than $5 million of gross receipts in the current year. And you can't have any receipts 5 years prior to the current year, right? So you're kind of sitting in this little 5-year window, and gross receipts can include basically anything that you would ever record on your tax return, from, normal operating receipts to interest income, grant income, right? So if you had, if you put money in the bank 7 years ago, as you formed the company, put money in the bank and generated $100 of interest income 7 years ago, you're not going to be a qualified, as ridiculous as that sounds, you're not going to be a qualified small business for purposes of this. And you're going to have to just take if you don't have taxable income, you're going to have to kind of sit on that credit and carry it forward and use it in future years. But if you are in kind of a startup world, you've got 5 years where you can use this, you can generate the credit and you can use it to offset your payroll taxes, which is a really nice benefit. There's most, I would say 50 to 60%, maybe as high as 70% have some version of a state R&D tax credit. Like I mentioned before, I think Connecticut's is by far the most lucrative. It's got a nice calculation method. It doesn't mimic the federal calculation. And it includes it really includes your 174 costs versus just the Section 41 costs. Most other states that do have an R&D tax credit pattern their credit after the federal, they limit it to their in-state activity. And there's a couple other states that would allow some sort of a monetization or an exchange, but it typically requires some sort of an application procedure. So I know that was a lot of material. I actually ran about 9 minutes over where we were supposed to be. So I know there's been some questions that may have come through, Gio. So I don't know if there's any additional questions. I'm happy to answer them here on the webinar, or my number and email address is listed on the last slide here. You can always feel free to give me a call at either number or shoot me an email, and I'd be happy to chat with you on, maybe your specific fact pattern on, what does 174 mean for my business specifically? I know, everyone's got different facts and circumstances. And so, each pattern needs to be reviewed and analyzed. And so, if you need assistance with that or just someone to talk to, and feel free to contact me at any time.
Yep. Yeah, thank you very much, Bill. Now, this was very informative. Like you said, a lot of information to absorb, and a big change though from 2021 and before to 2022. Now, I have a question. In the past, we were funded, we have funded R&D efforts, but these were firm fixed price. So basically, these were prime Navy contractors who fund us, but because we had an end deliverable, we were at risk, so we could write off those expenses, those R&D expenses. Had it been a cost plus, then because we were not at risk, then we could not write off those expenses. Is that still the case?
So that's a great question, Gio. So that gets into the whole concept of funded research, right? And so the answer to your question really depends upon whether we're talking about Section 174 and amortization, those rules that we talked about at the beginning of the presentation, or whether we're talking about taking an R&D tax credit. So if we are talking about the treatment under 174, the answer is it almost doesn't matter, at least at the current time. Now, the Internal Revenue Service could provide additional guidance, right? Whenever Congress passes these laws, they require interpretation by, the Internal Revenue Service. If we're talking federal, if it's a state law, I mean, they typically your legislators are not great writers of tax code, but they're the ones that write it. So until something comes out that interprets that differently, then in either case, right, whether you are getting paid a fixed fee or whether you're getting paid a cost plus contract, it's still going to go into your pool of 174 costs and still is going to have to get amortized over 60 months, but using the half-year convention, you're really going over 6 years, right? If we're talking about your R&D tax credit, right, then exactly what you said, Gio, is it would still be the case, right? So in that example, if you had a Navy contract and that was, funded by the Navy, but you one, own the technology, and two, it was a fixed fee, so there was risk on your behalf in terms of like financial risk, then that would not be deemed funded and would be eligible for your R&D tax credit. Okay. If it was determined that either one, you did not have rights to the IP resulting from the research, or two, like you had mentioned, it was like a time and materials reimbursement contract, then the IRS would deem that to be a funded cost and therefore not eligible for the credit, but still a 174 cost. So you're getting kind of both raw ends of the stick in that situation. But yeah, that's a great question, and it's something that we've seen. We have many clients that have these situations. They have federal grant funding coming in, and so typically on the federal grants, it depends on a lot of those contracts are, they vary, but that's what we would do. We would analyze the contract and analyze the ownership of the IP.
Okay, thanks. And I see that Jill has a question, hand raised.
Yeah, this is a really great webinar. There's a lot of information, very just really informational to me. I just have a question here. Our company is basically a software company.
Yeah.
We have developed the software, right? And we're selling the software. But over the 2022, basically, we have not really developed anything new, but rather we just basically maintain what we have.
Yep.
We do have developers, because you talk about software as part of the 174 cost. My question is, I guess, if we just maintain basically the software, we didn't do anything new, nothing experimental, would those software costs still be considered as the part of the 174 or no?
No, that's a great question, Joe. And you're one of the lucky parties, right? You can call your development in before the clock struck midnight.
Right.
Just be aware. I mean, it's interesting, as someone who's worked with the R&D tax credit for many years. It had to deal with IRS auditors, right? There's always been, your claim that it is research, the taxpayers claim that it's research, the IRS saying, well, you know, it's not research. That's going to flip, right?
Yeah.
That's going to flip as we move forward. Again, my opinion, I honestly think that, I mean, this is such bad tax policy.
Yeah.
I do think that it's going to get repealed. It may stick for a year.
Mhm.
But anyway, that's kind of regardless of the point. If your fact pattern is that no, and when you know, when we got to 2022, it was pure maintenance and there was no ongoing development, then those are just ordinary business expenses and should be deductible as they normally would.
Okay. That's just really, I want to confirm. Thank you so much.
Yeah, no problem.
Yeah.
Yeah, Bill, there's a question from, I think it's Cheryl. If LLC partners are not W-2 employees, can their time towards R&D still be included?
So guaranteed payments can be included as creditable costs. And so can other self-employment income, as long as it's reasonable. And of course, the IRS does not publish any guidelines regarding what's reasonable, but believe me, I've gone through with a number of clients to go through and pull general financial data to figure out, well, what does a president and general partner of a company in this sector of this size in this part of the country, what do they typically make? And so we had to go through that and say, okay, well, we think this is reasonable based compensation. And we think, and of course the allocation to that would have to be reasonable as well, right? I mean, typically if you have a president of a company who's also a partner, to have them allocated 100% to R&D is just kind of an unusual fact pattern. I'm not saying it can't exist, but it's, I'll just say this, the IRS would look at that very closely and it would, present a red flag. Now, if you had that same partner saying, okay, well, they are active and we can document that. And they're providing, maybe 40% of their time is related to R&D. If you can tie it to projects, even better. We didn't really even talk about substantiation of research expenses for the credit, but it's always the gold plan would be if you had project tracking and could tie all of your employees into those projects, and even, and even some of the executives or partners. So I hope that answered your question, but the general answer is yes, but it has to be reasonable.
Yes. Well, Bill, and thank you for that, because we keep very accurate timesheets for everybody, manufacturing as well as myself being the CEO and CTO. So it's good to know that we're doing the right thing.
Yeah, I mean, there's nothing. I mean, actually, in the tax credit audit manual, it does kind of present that, hey, taxpayers may have project tracking or they may not. They prefer project tracking. It's not a required element under the statute, but I do know this: there has to be a substantiation of the cost, and there has to be some sort of like direct causal nexus between the activity and the research expense. So just going down your employees and saying everybody's at 80% without having any kind of, thought process behind that is generally frowned upon by the IRS. But I can tell you, I have many clients that, just for other business reasons, they just don't do project tracking. And when we file our credit claim, we will have to come up with some reasonable allocation of people's time. If we do that, but it's not tracked directly to a specific project, we have to do a lot more work on the back end of substantiating, well, how did we get to that method, and what is the work? And so, there's a give and take to it, and there's benefits to using both methods. My preferred method is using the project tracking, because I think there's just it's generally more contemporaneously performed, and the agents like it better, to be honest with you. Yeah.
Okay. Well, thank you. Any other questions from the participants? All right. Well, thank you, everybody. And again, this was very informative, a lot of information, and hopefully the law will change given the push that we have in this country for, to get back into being the R&D center of the world.
Agreed, Gio. Agreed. I mean, it's Well, let's see where we go, but it's the tax policy fuels business activity. It really does. And so hopefully we can get back to where we were and keep that incentive and that motivation, at least from a tax perspective, alive, so that companies don't feel like they're getting penalized by investing in research, because there's risk there, right? There's risk in research, and that's why they want to incentivize it. So, agreed.
Definitely. All right. Very good. Well, thank you, everybody. And this will be available on the Connecticut Tech Council website. And please reach out to Bill with any questions. You see his email there.
Great. Thanks, Gio.
Thank you.